All right, we are looking at page 6 of your finance part of your study guide, and I'm looking specifically at the bottom half of the page where the stock quote is shown to you here, and let's just go through how we figure out the parts of the stock quote. So it says what was the price of the stock at the end of the day yesterday. All right, so in order to find that, where we need to look is where the previous close was, because it's a daily report. So I am focusing on this part of the report right here. All right, so the price of the stock at the end of the day yesterday would have been $163. Let's see if I can write better. $163.50. All right, so that's the previous close. The highest price of the stock within the last year. We don't want to be looking on the graph for this because this is only going throughout the month of March. But the year range here, right? The year range is going to tell us where the lowest and highest of the last year is. So the highest price of the stock over the course of the year would be this upper one, which is $171.45. Okay, the graph shows the stock price for the last 2 weeks. What was the lowest price of the stock within the last 2 weeks? All right, well, to find that, let's just find the lowest point on the graph, and that would be right here, which if I look across here, it looks like it is at 150, maybe 155, because it looks like it's going by fives, by increments of 5. So I think this looks like 160, so I think that's 155. So we'll say 155 here. And then has the price of the stock increased or decreased since yesterday? Well, you can find that right here, how much it has gone up over the course of the day. So that's up $1.06 during the course of the day. So $1.06 increase. So those are the basics of how we read a stock quote. We can find other info on this if we need to, but that'll do it for that section. All right, go on to page 7. Suppose you purchase 15 shares of a stock, priced at $15.85, 45 shares at $153.52. So we just want to take the 15 times the price of those stocks and the 45 times the price of those stocks. And if you just put all that into a calculator, you should get a grand total of $7,146.15. That is your total. So we just need to multiply how many we're buying by what they cost. Simple as that. Okay, if you purchase 8 shares of a stock at $85.45 and then you sell them later for $105.36, what is your capital gain? So that means our overall profit. So if we take the sell price, 105.36, and we subtract the buy price, which is $85.45, that gives us a total of $19.91 profit per share. Now it looks like we're to assume that we sold all 8 of them, just the way it's worded. We sell them a year later, so I think it's meant that we sell them all. So if we multiply this by 8, what we end up with is $159.28, and that's your total capital gain. All right, so it's figure out the profit of one stock and multiply by how many shares, or you could do the total buy price and then the total sell price and subtract those two. That would have worked as well. Okay, a stock pays an annual dividend of $1.20 per share. We own 52 shares. How much will we receive in dividends this year? Okay, that's pretty simple. So we have 52 shares and each one pays $1.20. So if you multiply that out, you get a total of $62.40. No worries there. It's possible that a stock could pay a quarterly dividend though, and then it'd be 4 times per year, so you'd have to adjust that if that's the case. Shares of a mutual fund decrease in price. What is a percent decrease? Okay, so then percent decrease is always going to be done by taking the new minus the original and dividing it by the original. That's your formula for percent decrease, or percent growth, depending on the problem. Okay, so in this case, that would be the new price of $65.74 minus the original price of $75.65 all of that divided by the original price of $75.65. So when I subtract the numerator, I'm going to get the amount that it was lost and then divide it by the original amount to see what the percent decrease was. So that would be, it comes out to negative 0.13. If you multiply by 100, we can get a percent, so negative 13%. That's your overall percent decrease. Okay, Gavin purchases shares of an ETF for $14.58, sells them for $45.96. So that's a pretty big profit. So if we take the new minus the original divided by the original again, that's going to be $45.96 minus $14.58, all divided by $14.58. All right, so that looks like it divides out to 2.15, but we want the percent, so we need to multiply by 100, and that's going to be 215%. All right, 53. Jillian invests in a fund that has historically earned an 8% rate of return. Estimate the number of years it would take for her investment to double. All right, that's the wording right here that's the key. So this is going to be the rule of 72. Anytime we need to know about a doubling, goes again in number 54. All we do is divide 72 by either the percent to get the years, or you divide 72 by the years to get the percent. All right, so that it goes either way. So you're either dividing by the years or dividing by the percent, whatever it is you know, and it gives you the other thing that you're solving for. All right, 55. Okay, explain how investing in a fund, such as a mutual fund, ETF, or index fund, can reduce the risk of losing money while investing. All right, well, these funds, all of them, are purchasing stocks in a variety of companies. So we purchase stocks from a variety and so that makes them diversified. When we're diversified, we don't have all of our eggs in one basket, so to speak. We don't have the risk because if one sector goes bad, then we lose everything. If we're across a variety, then they all kind of counterbalance each other. The other thing about this is you don't make the purchasing decisions for yourself. And so it's now in the hands of experts, or it's automated. So either the expert is going to do it, or your fund advisor is going to, your fund advisor is going to do it, or it's going to be automated. Either way, you're not leaving it to yourself to try to figure out. So those are reasons why it reduces the risk. What's the difference between actively and passively managed funds? So an active fund would be a human manager who tries to outperform the market. So that's high risk, high rewards, potentially, and high fees. But the passive is just the opposite. The passively managed fund, it is automated, and it tries to match the market. So it's more conservative. It's not trying to outperform the market. It's lower risk, which comes with lower rewards, potentially, and it's also lower fees. Okay, so those are the main differences there. All right, on to the last page of this packet. Let's work through page 8. All right, determine if each statement is describing a mutual fund, an ETF, or both. So the mutual funds are the ones that are managed by an active manager. So that is what letter A is getting at. An ETF is automated, so just mutual funds there. Funds contain a variety of assets. That's actually what a fund does, whether it's a mutual fund or an electronically transferred fund, so that is going to be both. These funds can only be bought and sold once per day at the end of the day. That describes a mutual fund. You cannot be trading those all day. It's just once at the end of the day that it's bought and sold. And finally, these funds have no minimum investment requirements. That is an ETF, when you can get in for very cheap, partly because it's automated, and then you don't have quite as big a commitment to it. All right, 3 factors that might influence a person's retirement age. One of them is financial stability. And what I mean by that is, do you have enough saved? If not, you got to keep working, right? So do you have enough saved to manage your retirement expenses? Item number 2, factor number 2 is your health. All right, so are you healthy enough to keep working? If not, you might want to consider retiring. And item 3 is your insurance. So do you have another option to replace your employer's insurance? As soon as you stop working, you've got to get your own insurance, which can be quite expensive. So you have to decide, do you have another option that is going to be affordable or manageable in order to replace that insurance that you've been getting from work. Okay, explain why it is beneficial for a person to start saving as early as possible. So your growth will be slow at first. So if you wait until the end to start saving, you're going to do all that slow growth at the end, and that's not what you want. You need that high growth in order to be able to get to your retirement amount that will fund your older years. So then, after the growth is slow, it ramps up as it compounds. But that takes time, so it compounds over time. You need time for the compounding to work. Okay, the curve is going to look like this. It's going to go slow at first, and then it's going to increase on an exponential curve there. Well, if you don't do this flat part until you're older, you're never going to experience the steep part. So that's why you need to start early. All right, so we're matching up each type of retirement account to its description, and that's where we'll leave this section. So 401k, well, let's go through it this way, actually. Let's look on this side. This account is similar to a 401k. Well, then it's not the 401k. But is for employees of nonprofit organizations, schools, or religious organizations. So that is your 403b, which acts like a 401k, but it's only for those types of jobs. This account can be opened by anyone with earned income. Taxes are paid when the money is withdrawn at retirement. Okay, so that would be a traditional IRA, because remember, it is traditional to pay taxes when money comes into your account. So if you're getting the money into your account at the end and you're taxed then that's the traditional form of the IRA. That's the way you can remember it. All right, letter C, this account is set up by employers for their employees and allows employees to have money automatically deducted from their paychecks. So again, we're talking about an employer account here, which is one of these first two. If it's not for a nonprofit organization or schools or anything like that, it's going to be a 401k. And that does leave Roth IRA for D, but let's look at that. The account is the only one listed where taxes are paid before the money is deposited. Okay, that is the benefit. So you pay into your account before money is taken out, and then you do pay the taxes at retirement, but at withdrawal, but then you're going to be able to it's going to grow tax-free as you go. All right, so I think I actually said that a little bit wrong, that last one. So the taxes are paid before the money goes in. You're not paying into the account. You are paying your taxes, and then with that money that's already been taxed, that's what funds the account. So then when you get older and you go to withdraw that money, since you've already paid the tax, you don't have to pay it again. So this is the form of a retirement account that you don't pay the taxes when you're older. All right, so we'll leave it there for this one.